Hey everyone, and welcome back to another episode. Smart money concepts bring several benefits compared to other trading approaches by offering precise guidelines for chart interpretation. This approach simplifies the process of reading price charts and allows for the execution of high-risk to reward setups without added stress. In today's video, we'll begin by breaking down the essential smart money concepts that must be applied to charts before entering any trades. These include determining the market direction, analyzing market structure, locating key supply and demand zones for trading setups, and identifying areas of liquidity. We'll also walk you through a detailed, step-by-step breakdown of the most effective smart money trading models that every trader should be familiar with. So if that sounds like something you're into, go ahead and smash the like button to show your support, and don't forget to subscribe if you're new. We regularly post in-depth trading content. Catch you right after the intro. Let's begin with the core principles and basics. First, determine market direction. Is it supply or demand that's currently dominant? Recognizing the prevailing direction is usually the initial step when evaluating a price chart. Our goal is to pinpoint the trend and assess whether buyers or sellers are holding control. We always look to place trades in alignment with the side that's currently leading the market. So, how does the methodology function? This strategy relies on mitigations. When price revisits a demand level, demand begins to overpower supply. On the flip side, when price returns to a supply zone, supply regains dominance over demand. Picture the market moving in an uptrend, forming a sequence of higher highs and higher lows. With every move that breaks the structure upward through inefficiency, a demand zone gets established. These demand zones stay unmitigated until price revisits them, presenting a prime chance to trade in line with the prevailing trend. But if price drops below a confirmed demand zone, this marks a change of character, signaling two key shifts. First, supply has taken control from demand. Second, a valid supply zone is now in place. Price action typically continues downward, creating more supply zones until it encounters the next unmitigated demand zone. At this stage, a struggle between supply and demand occurs. Often, this leads to consolidation or a ranging market between the zones. A break above or below either zone reveals which side is now in control. In this scenario, we observe move 1, 2, and 3 breaking above previous market structure, signaling that demand holds the upper hand. An unmitigated demand zone has formed and is likely to serve as support once price revisits that level. Following a brief retracement, the price again pushes upward, breaking the previous high with imbalance, resulting in the formation of another strong demand zone. The market still holds a bullish sentiment as long as the price remains above this extreme demand level. Now we see the price revisit this demand zone, but it fails to print a new higher high, pointing to weakening buyer momentum. After price dips below the recent low, it suggests that buyers have likely lost control, indicating a potential reversal. If we take this area as the origin of the impulsive move that shifted market structure, this would now become our supply zone. From here, price continues to break structures to the downside, indicating that supply has taken over and is now dominant. This leads to the creation of several supply zones, each one a potential short opportunity until price reaches the next unmitigated demand zone in front. That specific demand zone could serve as a point of buyer interest, where the bulls might re-enter the market. At this stage, a tug-of-war unfolds between buyers and sellers, and it's crucial to watch how price behaves. This zone could be a potential reversal point or at least trigger a temporary pullback. Here's something critical to remember. We can't control the market, but we can always prepare for the various outcomes that might unfold. Let's continue with our next topic, smart money market structure. Market structure reveals critical insights, like overall market direction, key supply and demand zones, liquidity areas, and potential trade setups. Now, let me walk you through some foundational ideas around smart money's approach to market structure. In a textbook uptrend, price action forms consistent higher highs and higher lows. Each time the market pushes past structure to the upside with visible imbalance, a new demand level forms by default. This buyer-seller imbalance is spotted by identifying fair value gaps, FVGs, in price movement. The demand zones that are responsible for forming FVGs are highly significant and form the core of chart interpretation in smart money concepts. As long as the price holds above such a zone, demand dominates and market bias remains bullish. However, if we see a break and close below that zone, it signals a change of character, pointing toward a potential trend reversal. In summary, the levels responsible for forming FVGs and structure breaks make up the key points of our market structure analysis, and market behavior around these levels provides valuable data. This logic also holds true for bearish trends. Always remember, in smart money concepts, market structure and liquidity zones are tightly linked. Many liquidity areas gain relevance from market structure itself, while several structure levels lose context without liquidity-based interpretation. Liquidity zones are key areas where retail traders typically become active in the market. We understand that zones showing repeated price rejections often attract retail entries based on conventional strategies. As a result, a large number of stop-loss orders and liquidity pools tend to build up just beneath or above those areas. Smart money strategies aim to trigger or sweep those stop-loss levels placed by retail participants. Our goal is to position ourselves after this liquidity has been cleared, taking advantage of the shift that follows the stop-loss hunt. Now let's walk you through some of the most effective models that integrate market structure with liquidity zones directly on the chart. The first setup is a classic example of a liquidity sweep through a major market structure level. Looking at the 30-minute chart of gold, we can observe a clear bullish trend. There's a well-defined support zone that has seen multiple rejections, signaling that many traders expect a bounce from this level. Price action traders often look to go long when price nears such levels, predicting another rejection. At the same time, traders already in long positions typically defend their trades around this area. This makes it a high liquidity zone, where a concentration of stop-loss orders is likely positioned just below. So where does a smart money trader focus? If we examine the left-hand side, we can spot a fair value gap near the lows. This also acts as an extreme demand zone. That becomes our key point of interest, and we start looking for buy setups in that region. As a smart money trader, the goal is to get involved after liquidity has been cleared, utilizing a precise blend of market structure and liquidity dynamics for optimal entries. Now let's dive into the second liquidity-based model. In this setup, we have a valid order block that presents a potential long opportunity. However, if we examine the left side of the chart, we can identify a price gap between candles, located directly below the initial order block, along with another valid order block in that same region. This price gap typically acts as a magnet, drawing price downward to rebalance, clear liquidity below the first order block, and then potentially reverse after mitigating the second one. Here are two important takeaways. First, always review the left side of the chart before entering a position to avoid unnecessary exposure to risk. Second, when this pattern appears, where a gap and another order block sit directly under the first one, we do not treat the break of structure as a true change of character, since this movement might simply be a liquidity sweep rather than a genuine reversal. With that covered, we've now gone through the essential tools for general chart analysis, including how to determine market direction, identify key levels, and spot high-probability trade setups. Let's break down 3 of the top smart money trading setups, step by step, including all the essential rules. We'll begin with the basic order block entry. Order blocks are refined supply and demand zones that emerge when there's a sharp price movement with imbalance, which also leads to a break in prior market structure. Typically, we mark the final candle that generated the fair value gap as our order block, under the belief that this is where significant decisions were made. This setup is straightforward yet powerful. In this strategy, we apply a standard order block entry, but only when it aligns with key market conditions. Step 1 involves spotting a valid, untouched order block that has formed recently. A valid order block must clearly show inefficiency, marked by fair value gaps between candle wicks, and must coincide with a market structure break. Next, we place a buy order slightly above the order block zone, roughly the size of the spread, and set our stop loss just beneath the nearest swing low. We take partial profit at a 2R level, meaning twice the amount of our initial risk. This helps us lock in gains and move to break even, so even if price reverses and tags our stop, we avoid a net loss. For the final target, we look toward the next significant level in the path of price movement. To boost the efficiency and profitability of this strategy, make sure to always trade in line with the market direction. This strategy performs best when used as a trend continuation setup. Only enter trades when the overall market direction is clear and the dominant side, buyers or sellers, has been confirmed. Staying aligned with the prevailing trend not only boosts your probability of success but also helps avoid getting caught in false moves or reversals. Check higher time frame key levels before trading. Always analyze the key levels on higher time frames and evaluate how much space the price has before approaching them. Even a minor reaction from a significant higher time frame level can signal a potential shift in direction on lower time frames. When price interacts with these major zones, there's an increased probability of a short-term reversal. So, make it a rule to examine higher time frames to understand how close or far price is from important levels. Analyze the left side of the structure before placing any trades. Always review the structure on the left side of the chart to filter out low-quality trade setups. For example, if the current order block lies within a liquidity zone or there are price gaps along with another order block right beneath it, the likelihood of a liquidity sweep becomes significantly higher. The second trading strategy: order block entry with liquidity sweep. In this setup, we combine the power of order blocks with a liquidity sweep for a more refined entry. Let's assume the market is in an uptrend and has recently broken structure to the upside, but without any inefficiency present. On the left side, we observe inefficiency just beneath the swing low along with a valid demand order block. In this case, there's a high probability that price will dip below the swing low, sweep liquidity, and then rebound strongly after tapping into the demand zone. When this structure forms, we position our buy order as spread size above the order block and place our stop just below the swing low. Our first target should be the next logical resistance or supply level ahead. This strategy is built on combining a liquidity sweep below a minor demand zone with a solid order block. The same logic applies in a bearish market, using supply zones and liquidity sweeps above swing highs. The third trading setup: order block within order block strategy. This setup utilizes a multi-time frame approach to identify high-probability trade entries. We begin by analyzing the overall market direction and identifying key structural levels. The first step is to mark a valid higher time frame order block zone based on the dominant trend. Once the price returns to this zone, we then drop down to a lower time frame to observe price action closely. At this stage, we wait for a clear change of character, a signal that the short-term downtrend, or uptrend in a bearish setup, has potentially ended, indicating a shift in market sentiment. If there is no confirmed change of character, we avoid entering the trade. This confirmation is essential to align both timeframes and avoid false signals. Once confirmed, there are typically two common scenarios for executing entries, based on how the price behaves within the lower time frame structure. Change of character with inefficiency and order block. When the change of character is followed by price inefficiency and the formation of a new order block, we place a buy limit order slightly above the newly formed order block, a spread size above. Our stop loss is positioned just below the swing low for proper risk management. In this setup, we manage our trade by trailing the stop loss. Each time the market breaks structure to the upside, we adjust our stop below the most recent higher low. This dynamic risk management technique allows us to maximize potential profits as the market continues in our anticipated direction, all while reducing emotional pressure and exposure. Change of character without inefficiency or order block. When a change of character occurs without any visible inefficiency or order block, we rely on Fibonacci retracement levels to identify our entry point. Using the retracement tool, we draw from the beginning to the end of the move that caused the change of character. We then look to enter a buy position within the 61.8% to 78.6% retracement zone, anticipating a continuation of the trend. This strategy is not restricted to any specific time frame, but it's crucial to ensure that your entry time frame is at least 2 levels lower than the higher time frame used to mark the key structure. So that wraps up this video. Thanks for watching. I hope you found value in this video. If you did, please give it a thumbs up and consider subscribing to the channel if you're new here. Your support helps us continue creating more content like this. See you in the next episode.